Every day, millions of investors trade shares in the open market, all trying to answer one difficult question. What is a single company actually worth? Take a look at the charts behind this man, Peter Lynch. Those upward trends represent a record of 29% annual returns for 13 straight years. To find the kind of value that generates those returns, most amateur investors start with one baseline metric, the price to earnings, or PE ratio. This equation shows how it works. You take a company's current stock price, say $30, and divide it by its earnings per share, say $3. That gives you a PE ratio of 10. You are paying $10 for every $1 the company earns. The standard assumption across the market is that a lower PE ratio indicates a cheaper, more desirable stock. But grabbing a stock just because it has a PE of 10 while passing on one with a PE of 30 is a risky habit. In many cases, the seemingly expensive stock is the better investment. The math of a basic PE ratio only takes a snapshot of a company's current reality. It tells you nothing about the trajectory of the business tomorrow. To solve this problem, Mario Farina and Peter Lynch brought a second variable into the math, growth. This formula represents the PEG ratio, price to earnings to growth. You calculate it by taking that initial PE ratio and dividing it by the company's annual earnings growth rate. Let's test that expensive company with a PE of 30. If it is growing its earnings at 30% a year, the math leaves us with a PEG ratio of exact 1. Now run the numbers for the cheap company with a PE of 10. If it is stagnant and only growing at 5% a year, its PEG ratio jumps to 2. Lynch established a baseline for this metric, known as the rule of 1. A PEG ratio below 1 suggests the stock is undervalued, while anything above 1 suggests it is overvalued. A higher price tag up front is mathematically justified if the company is expanding fast enough to outpace its cheaper competitors. However, the PEG ratio still leaves an investor waiting for that growth to materialize before seeing a return. This updated formula is Lynch's final adjustment, the PEGY ratio. It expands the equation to include the dividend yield. Imagine two different businesses competing for your capital. They have identical PE ratios and the exact same projected growth rates. The tiebreaker comes down to cash. If one of those companies offers a 3% dividend yield, its PEGY score drops below 1, making it the mathematical winner. Lynch applied this specific metric to identify early winners like Dunkin' Donuts and Home Depot, spotting value well before the rest of the market caught on. The safest bargains in the market balance the promise of future growth with the guarantee of cash payouts today. This leaves us with a 3-step framework. First, you calculate the PE ratio to establish a baseline price check. Second, you use the PEG ratio to test whether the growth rate justifies that price. Finally, you factor in the dividend yield to find the PEGY ratio, giving you a total picture of value. But the market is rarely as neat as a spreadsheet. These mathematical formulas are a starting point, not a guarantee of success. A company could have a mathematically strong PEGY score and still fail if it faces a weak competitive position or high market risks. While the math is simple, repeating these calculations for dozens of potential stocks across your watch list requires pulling data from various financial reports. True investing mastery comes from using the PEGY framework to identify potential bargains quickly, leaving you with more time to study the fundamental health of the business itself.